A lot of what you think you know about personal finance, even from some of your favorite creators, is completely wrong. These myths have been repeated so often that they're sometimes taken as gospel. But let's just get right into it. You've probably heard this one before. 70% of Americans are living paycheck to paycheck. This statistic is thrown around a lot. You'll see it in big name publications like CNBC and sometimes Forbes. Even your favorite personal finance content creators like to repeat it like it's a fact.
The people making over $100,000 a year, 51% of those people are living paycheck to paycheck.
A survey conducted by payroll.org showed that 78% of Americans are living paycheck to paycheck.
Because if you look around, 70% of Americans are living paycheck to paycheck.
But here's the thing, this statistic is usually from payroll.org or Lending Club or Bankrate. While it's a catchy headline, it's not telling you the full story. First, you have to think about the source of this content. Payroll.org advocates for getting paychecks to workers faster and more frequently through innovation, so they are incentivized to paint a picture of workers in despair that need the cash as quickly or as efficiently as possible. Lending Club and Bankrate are banks, and they advocate directly for loans. They want to get you in loan products as much as possible because that's how they make their money. And this is just the type of product you sell if everyone were really in financial ruin without a paycheck. The problem with this myth is it paints a picture of the economy on the brink of collapse, making it seem like the vast majority of Americans are one bad day away from financial ruin, but the reality is a lot more nuanced than that. It's a pretty good thing that our federal government conducts surveys and asks direct questions. The Federal Reserve actually conducts an annual study called the Report on Economic Well-Being of U.S. Households, which provides a more accurate picture. According to the Fed's most recent report, 82% of adults in this country said they are expected to be able to pay all their bills in full that month. 82%. Let that sink in. But it doesn't stop there. When they were asked how they would handle an unexpected $400 expense, 63% of adults said they would cover with cash or cash equivalents, which includes savings, credit card that they could pay off immediately. That's a significant portion of the population with at least a small cushion. And here's another stat that's probably the biggest indicator that the 70% are living paycheck to paycheck is completely false. 54% of adults have enough money set aside to cover 3 months of expenses in an emergency fund. 3 months of expenses. 3 months is not paycheck to paycheck. If you have a cushion of 3 months, you're not living paycheck to paycheck, and you shouldn't be calling yourself paycheck to paycheck. So there's no way that both the 70% number and the 54% number that the federal government survey says are both correct. And I'd like to err on the side of believing our federal government rather than believing these random polls from these bank institutions. This is not the image of the financially destitute population that's living paycheck to paycheck that they want you to feel. And just to drive home the point a little bit further, we're also spending more than ever on travel and dining out and leisure. So while it's true that some people are struggling, the idea that Americans are just scraping by is completely false. In most definitions I've seen, paycheck to paycheck means every dollar is used and allocated before your next paycheck arrives. And this is also reiterated in the definitions of paycheck to paycheck I see on Investopedia and Reddit and Rocket Money, where they describe people having no money left over after their expenses. And yes, I get going into your savings to cover an emergency expense isn't fun, but if you have that emergency expense and it covers 3 months, you are not living paycheck to paycheck. I think it's really important to have a realistic understanding of where the average American stands financially, and this helps compare yourselves fairly. I see a lot of comments online where people talk down on other Americans saying that we're all broke, and it's really disappointing to hear and see people talk about other Americans like that, when in actuality, for the most part, we're all doing pretty well. If you're enjoying this content and want to hear more, definitely like and subscribe. I post a bunch of different content on various financial topics, from the job market to the housing market. So thanks for watching, but let's move on to the next myth. Myth number 2 is a big one. Just invest 15% of your income and you'll be set for retirement. You've probably heard this from Ramit Sethi and Dave Ramsey, or read it on a website like Vanguard or Fidelity. The idea is that if you consistently invest 15% of your income, you'll be able to build enough of a nest egg where you'll be able to retire comfortably. But here's the catch. This advice is based on some major assumptions that don't apply to most people. This rule assumes that at the latest you start investing at 25 and there are no major life disruptions like losing a job or buying a house or having a kid or any medical emergencies that may be costly. And all those things might throw a wrench in your savings plan. And let's be completely honest, most people do not have a perfectly smooth financial journey from the age 25 until retirement. There are some bumps in the road. Another big issue is that people don't start investing until later in life. For example, nearly 50% of families headed by someone under the age of 35 have retirement accounts. But the median account balance is just $18,000. That's not a lot to work with if you're starting late and contributing 15% moving forward. If you start at age 35 and you have that $18,000 to start and just want to replace 71% of your pre-retirement income, that 15% is going to be significant ways away from what your retirement goal is. So what should you do instead? The key is to personalize your approach. If you started saving late or your current retirement savings is a little bit below where you want it to be, you might need to save more than 15%. It's all about knowing your number and your goal based on your lifestyle. You should also consider other strategies like increasing your income, reducing your expenses, or delaying retirement in general. Consider the life you want to live when retired. And like Ramit Sethi always says, what does your rich life really look like? You got to keep in mind that rules of thumb like the 15% rule can be a helpful starting point. They're not a one-size-fits-all solution. It's crucial to adjust your financial strategy based on your unique circumstances to ensure that you're on track for the retirement you want for yourself and your family. And now on to the final myth, and this one kind of gets under my skin. I've seen this one scattered all over the internet, not particularly from finance YouTubers. They normally have pretty good or solid data. But coming from the non-financial space, when they talk about money or finances in general, you have content creators who do a quick Google search and pull up something like $38,000 as the median American income. Sometimes you see a salary like $48,000 a year on a CNBC article or some other places. And they'll say they get the data from the Bureau of Labor Statistics. So I looked into it myself and I wanted to see what the Bureau of Labor Statistics is actually saying. While these numbers are technically accurate for the whole population of the United States, there are gross misrepresentation if you're trying to compare yourself to the typical working person. The problem is that the $38,000 number includes all Americans, whether they earn an income or not. This means it includes kids, retirees, those who are out of the labor force or on disability or only work part-time. If you're trying to get a sense of how your income stacks up against other working Americans, the number you should be looking at is for full-time workers. According to the Bureau of Labor Statistics, the median weekly earnings for full-time workers in the United States is $1,143, which annualizes to $59,436 for Q2 of 2024. Even that number isn't perfect because it includes anyone working full-time over the age of 16. The clearest and most realistic reference point for the average American worker is the median income for those 25 and older. The Bureau of Labor Statistics reports this number as $1,201 per week as of the second quarter of 2024, which annualizes to $62,452 over the course of a 52-week year. This is a much truer reflection of what a typical working adult is earning. So if you're earning less than about $62,000 a year, you're actually below the median for full-time workers aged 25 and older. This is a much more accurate comparison point than the mythological $37,000 a year or the $48,000 a year figure that gets thrown around online. It's important to use the right benchmarks to understand your financial standing relative to your peers rather than misleading data. So there you have it. Those are the three biggest personal finance myths. Debunked. Not everyone is living paycheck to paycheck. 15% might not be enough for retirement, and that $37,000 to $48,000 a year is nowhere close to the median income for an American. If you found this video eye-opening, hit the like and subscribe. Thanks for watching. I'll see you in my next video.